Hey everyone, welcome to Retire with Style. I'm Alex and I'm here with my good buddy Wade Pfau, and we're gonna hit it off with another edition of our Q&As. Right, Wade?
That's right. That's right. And the theme, trying to put together questions into a theme, it's kind of sequence risk, discretionary spending versus essential spending. That's kind of the underlying theme today.
Think about a big Thanksgiving feast when they have that basket with all the foods in it and the cornucopia of delights.
Yes,
This is
we've got
kind of
a
what we go ahead.
cornucopia of questions.
There we go. There we go. All right. So let's hit the ground running. First one from Wurzel and Goumage. It could be French. I don't know. This one dealing with 4% rule and rebalancing. I have seen the 4% rule, and now I see buckets and rails and sequence of risk. None of these, though, go into, at least broadly, what was or is the formula used in extracting funds from a portfolio. Is there any details on the selling formula used in all of these cases, or in the grandfather of all the 4% rules?
Mm-hmm. Well, I'd say that the buckets have a pretty clear rule on where you're spending from, but yeah, this gets into, in the previous episode, we were talking about one of the limitations of like the 4% rule, but really all the research in the safe withdrawal rate space was that it didn't really consider taxes. Well, this question gets at another extension of, if you're not really even considering taxes, you're not really worrying about where you're spending from, because one of the basic assumptions of 90% plus of the safe withdrawal rate research is you're always rebalancing to your targeted asset allocation every year as well. So it doesn't really matter, do I draw from the stocks or do I draw from the bonds, because I'm taking out what I need and then I'm rebalancing to the target asset allocation all at the same time. And I'm not worried about the tax consequences of that. So I'm not really paying attention. I guess just technically, if stocks are up, you're pulling more from the stock side as a part of getting rebalanced. If stocks were down, you'd be pulling more from the bond side to get yourself rebalanced. But it's ultimately, I'm distributing and rebalancing at the same time, and I'm not worried about the tax consequences. And therefore, I'm not really paying attention exactly to whether I'm distributing from the stock side or the bond side. That's how most of the safe withdrawal rate research works. Now, with bucketing, it's different, because bucketing is getting you away from just that total return investing approach. It's my short-term buckets are bonds, my long-term buckets are stocks. So I'm spending from bonds, and then if the conditions look appropriate, I'm going to rebalance by selling from the long-term growth buckets to replenish the short-term buckets. And I'll have some rules guiding when I do that. But it's pretty clear when I'm reallocating from stocks back into my bond buckets.
Well,
You
in the
can see that
buckets,
that's
though,
the difference for bucketing, really.
but in the buckets, though, Wade, I think you have to clarify bond funds or bonds.
Well, when we talk about time segmentation as a retirement income style, we do mean like your short-term buckets are really laddered bonds held to maturity to meet upcoming expenses. But in real life, there's no clear definition on what people mean when they talk about time segmentation. So there may be practical uses where the short-term buckets have bond funds in them. They're probably relatively short maturity, short-term bond funds. So hopefully they don't have a lot of interest rate risk. But yeah, it's still the same idea. You're selling bonds to cover expenses. And then when deemed appropriate, you're selling stocks to replenish the short-term bond buckets. And again, whether it's a bond fund or a individual bond isn't overly important for this particular point.
Okay. For what point would it be particularly
Well,
important for?
for exposure to interest rate risk,
Say
where
it again?
bond funds really aren't, the whole idea of time segmentation is you want reliable income, and you get that by holding individual bonds to maturity to meet upcoming expenses. You don't get reliable income from a volatile bond fund that's exposed to interest rate risk and has a maturity that's not necessarily matched to the duration of the expenses you're trying to fund.
So if I'm listening to you clearly, effectively, the word formula is the key word in this question. And what was or is the formula for extracting funds from a portfolio? If I'm listening to you, the formula is effectively whatever it is, as long as your allocation remains in line with what it was originally intended for.
Yeah,
As
like
long
if
as you
you're
maintain the
targeting,
allocation, that's the formula. It kind of is
yeah, if
what I'm
you're
hearing from.
targeting 60/40, it's all at the same time. Since you're not paying attention to taxes anyway, at the same time, you take the distribution and rebalance. So you're not really paying attention to what you're drawing from. You're just going to be rebalanced again at the end.
Yeah. I don't know what else the formula could be, right? I like in the wording of the question. What?
Well, if you're not automatically rebalancing there, and this is where there's limited research that would look at when do I want to cover expenses through distributing from the stock side, and when do I want to cover expenses through distributing from the bond side, which again was very clear in time segmentation, but even in a total return environment, you could do that, and then you'll just have a dynamic asset allocation.
Okay. So next one, let's go into sequence risk. Thomas asks, sequence of return risk is real, but it is overhyped for the average investor. I love Dr. Pfau's research and have his primary book. However, banging that SORR drum without
That
the
sequence of
proper
returns risk.
Oh, sorry. Sorry. Banging the sequence of return risk drum without proper context of the low practical risk for most investors causes people to be overly conservative. I would love to see Dr. Pfau share what the sequence of return risk odds are for the typical 65-year-old retiree and the typical portfolio. My guess is that the practical risk is no greater than 15 to 20%. Not zero for sure, but not 70% either. Also, the sequence of return risk typically plummets for the typical investor, assuming they delay bridge to maximize Social Security when Social Security starts. This would support Dr. Pfau's rising equity glide path option. So, what do you think, Dr. Pfau?
Mhm. Yeah, I'm not 100% sure what these numbers mean in terms of like, is a
I think he's just
sequence
making
of
that up
return.
and using it as an example. Like, for
Yeah,
instance,
and
I don't
even
think
if
it's more than, it's his intuition. Like, I don't think it's more than 70%. I don't think it's less than whatever.
and that I guess it's the risk of getting hit by a bad sequence of returns.
Yeah, that's how I'm reading this.
Yeah.
I'll say it another way. For that sentence, I would mean that to read, for the typical 65-year-old retiree and typical portfolio, my guess is that the practical risk, like falling into a bad sequence of return sequence, is no greater than 15 to 20%. Not zero, it's out there, but it's not like 70% like they make it out to be. When I'm reading this, I'm getting the sense that you're kind of creating your own kind of scenario and then assuming that's the universal truth of that, and there's a danger in that kind of thinking. But I'll let you, in terms of the numbers being, the question is a valid question. I mean, like the 70%, this or that, those are just made up numbers, but I think he's anchoring to that, and that's the danger. That's a danger in and of itself. But go ahead, wait for the actual meat and potatoes of the question.
Yeah, I mean, like, and also it might be misrepresenting a little bit how people talk about sequence of returns risk, unless it's really just a pure sales marketing campaign for annuities or something. I don't think anyone makes it sound like there's a 70% chance you're going to get hit by a bad sequence of returns in retirement. It's in the historical data research, it's really you're hit by the worst case market returns in
You,
history. So
you know
that
what? You know what this could be referencing to, that it makes, in your study, you point out the R square, the importance of the first few years has it's in the 70, right? It's going to
the
determine
first.
like 70 something percent of the variance, and maybe that's what's being confused with the actual probability that you're going to have a sequence of return risk.
Right. Yeah. The market returns in the first 10 years of a 30-year retirement will explain about 70 to 80% of what the safe spending rate was for
But
that
that's not
retirement.
saying sequence of return risk is you're 70 to 80% at risk. That's
Right.
completely
Right.
not what
That's,
that's saying.
yeah. By definition, getting hit with a negative sequence of returns, it's really kind of calibrated to either the worst case historical market scenario and getting worse than the worst case historical market scenario. And or just if you're using Monte Carlo simulations, if you're targeting a 90% success rate, it's like a 10% chance you end up with something worse than that. So I think it's already calibrated to be a relatively low risk. Again, maybe aside from sometimes folks on the insurance side in their marketing will maybe make it sound like the risk of a negative sequence of returns is higher than that. But no, I think, yeah, it's a concern. The other issue here too is sequence of returns risk is somewhat an artifact of the logic of the 4% rule, which is you always spend the same inflation adjusted amount no matter what your portfolio is doing. You don't ever cut spending as your portfolio plummets towards zero. So we've talked a lot about there's 4 broad ways to manage sequence of returns risk. And if you're using the 4% rule logic is just you spend less. You got to get that spending low enough that you don't get yourself into a downward spiral if your portfolio declines in value. But the other options are you use a variable spending strategy. You adjust your spending in response to portfolio performance. Or you have some mechanism for monitoring volatility, whether that's annuities or time segmentation or the rise in equity glide path. Well, there's more questions on that later in the episode, or actually was in this question. Yeah, something that trying to reduce volatility in the portfolio when you're the most vulnerable to a loss triggering a downward spiral from your retirement, or using a buffer asset, something outside the portfolio that can provide a temporary spending resource so that you're not selling from the portfolio in a decline. So indeed, in practical terms, you can develop strategies to manage sequence of returns risk. It is a unique risk. Well, it exists pre-retirement, but it gets amplified in retirement when you're spending from the portfolio. So it really is something pre-retirees may not really have thought about how sequence of returns risk would impact their long-term investment performance. It's something that really impacts you more when you're spending from the portfolio. It's one of the unique risks of retirement. It's something to be aware of, and it's something you'll want to have a strategy to help manage. But yeah, it's certainly not the case that there's a 70% chance you're going to get hit by a negative sequence of returns that leads you to have the worst case spending rate in the history. uh,
The
it's
other
more, it's a background risk.
the other piece here that I want to make sure it's clear, because I want to make sure it's not a red herring, in this sense. But however, banging on the sequence of return risk drum without proper context of the low practical risk for most investors causes people to be overly conservative. I want to just this opens up a kind of an interesting thought for me, which is I don't agree that this is why people end up being more conservative. Maybe, but I think people, people's withdrawals are more conservative not because of sequence of risk, but rather longevity risk, especially if you're taking a total return approach. Which, based on the cadence of this question, I assume this investor is a total return person. And it's not to protect from sequence of risk, although there obviously could be variables there. It's really more as a result of the longevity part of it.
Yeah,
That's why people
longevity.
are conservative.
hmm Longevity and market risk. But there's a fair point to that statement, which is because so much of the discussion of spending in retirement is linked to the 4% rule logic of you need constant inflation adjusted spending. And so then it just becomes a debate about how low does that constant inflation adjusted spending have to be so that you don't run out of money. That can make sequence of returns risks seem more dangerous than it really is. And again, because there are other means to manage the sequence risk. And again, a variable spending strategy helps quite a bit. So if the conversation around this could default to variable spending strategies, sequence of returns risk would not be as big of an issue as it is in the world where the default strategy is constant inflation adjusted spending. So I think there's a fair point being made with that statement in that context. But we can't dismiss sequence of returns risk. It is a
No, I'm
real
not.
thing. It can on occasion be overstated, but yeah, it's part of building a robust retirement income plan means having an approach to managing sequence risk. And there's a lot of levers you can use besides just being conservative with your spending. And so finding the right balance between your
Yeah, and if
options.
people are hearing this a lot, I think it's possibly because it's a relatively new term, and by new term I mean in the last 10 years. It's like, and you said a joke at the beginning, but I don't think you're too far off. It's the folks that are pushing annuities only. Sequence risk is another arrow they can put in they can pull from the quiver to say, aha, this is why you need to protect yourself at all costs from distributions from a portfolio only. And to what you're saying, and what I think this is what Thomas is feeling here, is that, hey, it's not as bad as you guys are making this out to be.
Mhm. Yeah.
All right. Next question from Peter, and this has to do with sequence risk and discretionary spending. Even if your daily needs are covered, you still have risk related to discretionary spending that for many people is desired earlier in retirement. It's not going to be much comfort if you have to reduce your discretionary spending early on, and then by the time you can afford to spend, you're no longer able to do things you wanted to spend the money on in the first place. So I'm trying to manage my sequence of return risk in such ways as to reduce the likelihood of needing to reduce my discretionary spending in the first 10 years of retirement. Maybe discretionary isn't discretionary and it's quasi-essential. Maybe you need a hybrid
Or,
spending category, Wade.
no, I think this question makes a lot of sense. But yeah, it's immediately, this is why the 4% rule logic is not the way to go, because what that gets you into, if you're never going to adjust your spending other than for inflation, you have to spend less early on. And then what that generally means, if you're not in a worst case scenario, if you're not impacted by sequence of returns risk, your portfolio just grows and grows. And then you could spend a lot more in your 80s and 90s, but no one wants to live frugally in their 60s when they're healthy and have the ability to spend tons with world travel and everything in their 80s and 90s when they may not really be able to do it at that point anyway. So we got to move away from the 4% rule logic. And I think this is providing a framework to do that. If you get your essentials covered through reliable income sources, you can be a lot more aggressive on the discretionary expenses. And we have a payroll calculator at the Retirement Researcher Academy where you can look at variable spending strategies. And some of them you're going to spend more aggressively early on, and that's going to generally cause you to have to spend less later on. But that if it's for discretionary, that's okay. That may be what you're looking for. You want like 10 years of high discretionary spending, and you're willing to make big cuts to the discretionary spending after that. But it's not going to jeopardize your retirement because you still have a floor of reliable income so that your basics are covered no matter what's happening with your investment portfolio. So you pick a variable spending strategy that's more aggressive early on. That will lead to less spending over time on average, but that's what you're looking to do here. You want to enjoy those go-go years, anticipating you may have some slow go and no-go years, and that you don't need constant inflation-adjusted spending for all of your retirement expenses throughout the entire retirement horizon. So
And that,
first fill the floor.
and then
Yeah.
piggyback on like spending styles, right? Where they don't, people don't spend the same amount every year. They by default, you naturally do have a variable spending style.
Mhm. Yeah, first build a floor and then expose to upside and pick a variable spending strategy that gives you the kind of pattern you're looking for. And in this case, it sounds like you're looking for big expenditures early on with a willingness to make cuts later on if necessary, because it's for the discretionary piece.
Okay. Next question. You want
And
to hit me
again,
with
yeah,
it, Wade?
that's a different strategy than the 4% rule. That's a variable spending strategy. And that's and I'm tying it to income
Wait,
protection.
sorry. Every once in a while, I think your mic, I think you're shifting away from the mic. It was a little tougher to hear you.
Well, yeah, I was just saying, I mean, this is fundamentally a different strategy than the 4% rule. There's elements, I'm talking about it more as income protection, where you have a floor of reliable income and then you just spend aggressively for the discretionary expenses. But even in a more of a purely investment-based framework, you're picking a variable spending strategy that allows you to spend more early on because you have a willingness to spend less later on. And I think that's the question's getting at. you'd be happier with that than with the opposite, which is where you don't spend early on, and then you could spend a lot later on when you're not really able to enjoy it. That's not a good outcome either.
But that's a good point. I think a lot of folks, frankly, don't maximize their enjoyment utility or whatever you want to say because of that sort of hesitation.
Mhm.
Okay.
Okay, I'll ask the next question here. I want to make sure I'm at the right one. Okay, yep. Hello, thank you for your excellent podcast and books. Mine is probably more of a question for your podcast than a whole episode. The question is, have you analyzed the use of dividend income for discretionary expenses to help reduce volatility and sequence of returns risk? This assumes essential expenses are already covered by contractual sources. Dividend sources would be a portfolio of individual stocks, preferred stocks, REITs, ETFs, closed-end funds with proven track records of paying consistent and or increasing dividends. Growth stocks would still be present in the portfolio as well. Understanding the dangers of chasing yield, so part of this analysis would be to help provide guidance on limiting stretch for yield, like a healthy overall portfolio income target in the present interest rate environment would be in the 3.5% to 4.5% range. Thank you both for consistently detailed and thoughtful guidance. From Gary.
Okay. Hey, Gary, thank you for the question. It comes up, quite a bit. And what we would say is dividend sources would be a portfolio of individual stocks, preferred stocks, REITs, ETFs, and closed-end funds. With regards to preferred stocks right away, it's kind of a hybrid between stocks and bonds, and you'll see research has shown a diversified portfolio. If you have a 60-40 portfolio, let's say, kind of preferreds may not be needed in that sense, simply because you get characteristics of both, and then there's just things get lost in the wash when you bring preferreds in the mix. That being the case, we personally, people differ in this, but I think as a best practice, especially within our profession, in terms of the larger independent wealth management firms, you really don't see. I haven't come across many advisors at all, frankly, at this level, that really look at a portfolio and look at a portfolio from a yield perspective, look at holdings from a yield perspective. I think personally it's a carryover from the 50s and 60s and 70s and 80s, even, where that was the thing, right? Make sure you have good dividend stocks, blue chip stocks that pay healthy dividends, etc. I get your point about stretching, and we do see that. When people start looking like that, then the yield creeps up and up and up, and that becomes almost like the number one factor when creating a portfolio, and that's just a road to perdition ultimately. And there's been all these books about like dividends, this and that. But at the end of the day, if you're creating distributions, you can create your own distributions from the entirety of the portfolio by taking a systematic withdrawal. In many ways, it may be more tax efficient for you than to just be relying on dividends. So on many levels, it's more efficient to simply just take a withdrawal from a portfolio, because you're effectively creating your own dividend, and you're not reliant on some board, in some company all of a sudden saying, this year, this is the dividend, and hopefully you can back into your lifestyle from that, right? The other piece why we're not big fans of this is that it just overly concentrates your portfolio. There's certain industries that are dividend rich. And from that standpoint, there's going to be significant opportunity cost by not investing in a broader market, and frankly, a lot more concentration risk. And it doesn't have to be loss. It could be, that concentration risk then leads to opportunity cost simply because you are in the railroad transportation sector, right? And that did nothing relative to other industries. So we just don't focus on interest rates. I mean, on dividend yields with regards to what's a reasonable amount. We focus on what's a sustainable withdrawal from a portfolio if we're taking a total return approach. It's a question that comes up reoccurring, and it's totally understandable why, because you see that a lot. I mean, frankly, I'm sure there's just dividend ETFs out there, and what they're trying to do is appease the folks that are just sticking with this dividend mindset. But all I can say from a best practice standpoint, it ends up being an inefficient way to draw funds from a portfolio. You're better off from a globally diversified portfolio. That's actually a better investment option than focusing on dividends. And then from the standpoint of sustainable withdrawals from a portfolio, I think you can match that for your lifestyle as opposed to backing into something based on what dividends are being paid at the moment. Wade, anything to add to that?
Yeah. No, I think that's a reasonable answer. And especially, I think your answer would apply if they're really stretching for yield. So if they're saying, oh, let me put together a portfolio yielding 6 or 7%, that could be a case where your answer really strongly applies. This
Well,
one does seem more nuanced in terms
well,
of,
because Gary seems like the question seemed very well thought out. He's not just saying, "Hey, let's gun it for dividends," but you do see over time people creep. It creeps higher and higher and
Mhm.
higher. So there's a danger in that, but let's give Gary the benefit of the doubt.
And also just to be clear, if you have a total market portfolio, what would it be kicking off in dividends and income these days?
Oh
Maybe
yeah,
2 to 3%.
exactly. 2 to 3,
If you can
in that range.
If you can live on that, yeah, you can have a total returns portfolio. You just don't have to sell shares to meet expenditures. That would mean you are overfunded for retirement. It's kind of the scenario where you're living off the cash flows from the portfolio.
And
If you'd like,
and
you could spend more, getting back to the previous question. But if you're comfortable with that and you kind of frame it as, I can live off the income being kicked off the portfolio and I'm not having to stretch for yield to do that, it means you're overfunded, but you're happy and you're going to potentially leave a large legacy at the end. And maybe that's part of the goal as well. This question did have a floor of contractual income already in place. So that gives them more capacity to take on risk. But your point applies. Just going for yield is not necessarily the most efficient way to go for that risk. You can spend some principal as well. But again, if you're comfortable living off, you've got basically a total market portfolio with a little bit of tilting for yield, and you're comfortable living off that. Behaviorally, I don't see a problem. It's really when you start stretching more dramatically for yield that you might be creating much worse outcomes for yourself.
behaviorally, I don't see a problem as long as you're not taking portfolio concentration risk with that.
Right. Which you would be doing. The more you stretch for yield, the more
Kind
this
of would be.
becomes a risk. If you're,
It
if
kind
you're
of
just stretching.
ultimately, it's like swimming in the current. Eventually you may get caught up in it. It's very hard not to, but assume Gary lives on the planet Vulcan,
Yeah,
and he's a very rational being, right?
not just the sweet, sweet yield. Must have more. That is that
All
the
right.
issue?
The next one, it deals with the theme of rising glide path from Kaushik. I found the reverse equity glide path mentioned that a method, sorry. I found the reverse equity glide path method that Wade mentioned during a previous meeting really appealing. Is that something you see used in practice frequently? What are the factors to consider?
Mm-hmm. And that maybe had come up with Bill Bengen actually talked about the rising equity glide path in his new book. So it's one of the few parts of the book that's really got something
You
updated.
said rising equity glide path. He wrote here reverse equity glide path.
I think he also means rising with
Okay, I
reverse
didn't
because
know
the
if that
idea
was
is
like a
instead of,
reverse mortgage thing or something that I
oh, no,
kind
not
of
like
missed the memo on. So I was like, okay,
I think
let's assume
reverse
you meant
equity glide.
rising equity glide path.
Yeah, I think
Okay.
that's, otherwise I have no idea what to say. I don't know. A reverse equity glide path has to be a rising equity glide path because it's a reverse of the declining equity glide path that we traditionally think of with age and bonds and that sort of thing. So the rising equity glide path helps to manage sequence risk because it has you with a lower stock allocation at retirement. But then as you go through retirement and as you have the ability to manage a negative sequence of returns and you get later into retirement where the market impact will be less, then you can increase your stock allocation again. So Michael Kitces and I wrote about that, like start retirement. Instead of being 60-40 stocks and bonds throughout retirement, maybe you start from 30% stocks at retirement, but work your way back up to 60% stocks in, say, the first 10 or so years of retirement. Manages sequence risk, doesn't hurt distribution rates or anything. So then the question gets into, is this something you see used in practice frequently? the pure total return version of it, where I specifically use an increasing stock allocation on my investments, I don't necessarily see frequently, although it does resonate. And so we hear messages like from Kaushik on numerous occasions where this resonates with people and they use it. I think in practical terms, where we see it used more is indirectly from the total household perspective, where if I build a bond ladder at the start of retirement and I don't replenish it and I keep the same stock allocation outside of that, I've just created a rising equity glide path for myself that way. Or if I hold a steady stock allocation, but I also have Social Security benefits, I have an annuity, the present value of the Social Security and annuities will decline over time to the extent that it's like a bond. That's another way you get the rising equity glide path in practice. So I think indirectly, a lot of people end up with a rising equity glide path in retirement, but where they're directly using an increasing stock allocation on their investment account itself, I don't think that's as commonly seen.
I mean, what we see here is I was going to make your point's right. Really a rising equity glide path, and we've mentioned it before. To me, it's like a bond a time segmentation strategy that you just don't like re-up right after one cycle. Now you do see this, whether it's technically a rising equity glide path, in the construct of distributions, probably not. But many times there's a client or somebody that, recently comes over, or somebody has a windfall and they want to put it into the market. But they want to, but they don't. And even, regardless of what you say about, going all in one shot or dollar cost averaging or whatever, there's always a hesitation because it's just human nature. All of a sudden you have a windfall. It's a significant amount of your asset base. And everyone reads the books, stocks stocks go up over the long term, yada, yada, yada. But there's always but things are a little shaky right now. And so just, as opposed to having it in cash, there's an agreement of, listen, we'll start this off at, your portfolio right now is, I'm making it up, 50-50. And what we're going to do is take this money and dollar cost average it into the market, but we're not going to put it in at 50-50. We're going to put it in at 70-30. So when we're done with this, it ends up being 60-40. You know what I mean? We kind of use that in a way to get folks just into the markets to get going, but in a manner that they're not losing sleep at night. I see it like that as well, as opposed to just a pure distribution play.
Yeah, I also asked about what factors to consider, and that's the pure version of it where you're changing your stock allocation. I think that's more of a total returns. If that's your style and it resonates with you, then I think you could reasonably consider using it. It doesn't resonate with everyone because once you get used to less volatility in early retirement, it can be difficult to have more volatility at advanced ages. So that's where it's certainly not going to work for everyone. But if you kind of understand the logic, you understand how it manages sequence of returns risk, and it resonates with you, then it's something you can definitely consider doing as part of your planning.
All right. Then we have here another question about the 4% rule. Is the 4% rule still a constant? I have seen it taken as low as 3% due to increasing life expectancies. Or does it vary depending on market conditions, etc.?
Yeah, so a couple of different directions there. Bill Bengen, the father of the 4% rule, defines it as based on U.S. historical data. So in that regard, it would be a constant. It's just what was the worst case in history. Now it has all kinds of assumptions: asset allocation, time horizon, investment fees, taxes, other things too. If as you change those assumptions, you can change the number, and that's why he talks the pure, based on the asset allocations he's using today, the pure safe max he talks about as 4.7% instead of 4%. And then also, if you bring in inflation into the mix, he says in a moderate inflation environment, 5.5% is probably more realistic than 4%. So, but it's still calibrated to market data. It's just what market data, what asset allocations do you want to use? Now, where you start seeing numbers like 3%, would be doing Monte Carlo simulations that link to current market conditions. And that's somewhat an artifact of, back around the pandemic, the entire TIPS yield curve was negative. You could not support anything close to a 4% distribution rate with a 30-year TIPS ladder. And that's the idea. You take the interest rates at the time, you add a risk premium for the stock market, you run simulations. 4% was not safe for quite a while. Today, that's really fallen by the wayside. Like if you build a 30-year TIPS ladder today, it could support about a 4.6% distribution rate with an average real interest rate yield coming out at around 2.2 or 2.3% plus inflation. So running that kind of analysis today, you're not going to see those 3% numbers unless you started to really get aggressive about assuming mainly a large investment fee taken off of the returns, plus probably much more than 30 years, 40 years plus investment fees might still get you under 4%. But I think the days of seeing 3% numbers are by the wayside due to the fact that interest rates are much higher today than they were when that research was coming out.
Fair enough. Alrighty. And then for the final one for today, it has to do with RISA styles. And the question is, why is the retirement planning community so hung up about the traditional drawdown paradigm in mapping out a successful retirement plan and not focusing in on the paradigm of guaranteed variable income model in which a lot of uncertainty and volatility of the drawdown paradigm is reduced or erased? I am seeing a trend in Gen Xers towards this type of planning. I am not a professional planner or influencer. The guaranteed paradigm could gain a lot of traction by educating pre-retirees earlier in their quest, maybe as early as high school.
Yeah.
Wait, why don't you fire off?
Well, this is like the fundamental question of retirement income. This is what makes retirement income different from pre-retirement wealth accumulation. In retirement, you have an asset liability matching problem. You need to fund expenses over an unknown time horizon. In pre-retirement, the focus is generally more on just growing assets, using modern portfolio theory to decide an efficient asset allocation to give you the highest risk-adjusted returns to grow assets. The specific number of years and the time horizon plays less of a role, and there's no liability that you're funding. And so the basic answer to this question is, yeah, it's really saying that the default is total returns for retirement. But that's because I think just it's what people are used to in the pre-retirement period. It's taking that pre-retirement investment management approach and trying best as possible to fit that into post-retirement, because there hasn't necessarily been a lot of thought about how risk changes post-retirement. Whereas going back with research, the efficient approach for building a retirement income plan is you really think about having more reliable income sources to meet essential expenses. And then you just draw a variable spending amount from the investments to meet discretionary expenses. And so that's the income protection approach. The question's really getting at and maybe pointing out the younger generation or even Generation Xers. I don't know, they're getting close to retirement at this point, but they may more naturally be inclined towards income protection approaches than older generations. I don't know
Well,
if
I don't see that. We haven't seen that way. I mean, when we do our cohort analysis, it seems, I'll say this, there's a significant number of people, you know this, 2/3 of the people want contractual income. And or tilt towards that sort of non-total return approach. And non-total return approach are either time segmentation folks, income protection folks, or risk rep folks, all which contractual income plays a significant role. So 2/3 of the folks already kind of are searching for that. So at the individual level, I think there's this desire for that kind of solution. Unfortunately, what happens is, based on what you said at the beginning, folks have been investing for accumulation for the majority of their lives, and many of them have been facilitated through investment professionals that are effectively creating, model portfolios in which have a certain growth expectations to meet a number when they retire. And unfortunately, what I think a preponderance of what those folks do at the detriment of consumers is they assume folks just want to continue with this type of investment approach and just flip on a withdrawal strategy on that. right? And part of that is because I don't think it's nefarious. I think it's more they're just not up to speed with the science of retirement income planning, as opposed to just creating a diversified portfolio for growth, right? And so I think that's why the retirement planning community is so hung up on it. I don't think they're hung up on it. I just think they don't know any better, And I say this in a half kiddingly, half serious kind of way, right, Wade? You know what I'm getting at here?
Yeah, they haven't thought about what makes retirement income different, and that's
Yeah.
retirement income planning is still a unique new field in financial services.
Yeah. Whereas, but interestingly enough, look who's bringing this question up. Somebody who's not a financial professional, planner, nor an influencer. No, but he's intuitively picking up on, hey, why isn't this done more when it's such a thing that's out there? So that's a good pickup, nugget, nugget new.
Yeah.
Wait, I have one more question for you, if you don't mind.
Oh, you're going off the grid.
Yeah. Are you a professional planner? Do you consider yourself a professional planner first or an influencer first?
I don't know that either one. I would consider myself more of an educator, but
Oh, no.
I would not use the term influencer for myself ever. So I guess in that regard, I'd have to be a professional planner.
You're too humble. You're too humble. Is that what you're trying to
I thought
tell
it was
us?
now a finfluencer is the term.
Oh, finfluencer?
But I don't even have a TikTok account, so.
Yeah, exactly. If you had a TikTok account, you'd be a fine influencer. But there we go. Bad joke. That's it. That's it for today, everyone, right? And we'll catch you in another Q&A session coming up next week.
All
Wait.
right. Yep. We'll catch you next week on Retire with Style.